Welcome back. It's time now to take a look at the top business stories. Etisalat to invest up to 3 billion dirhams annually over the next 5 years. All UAE-listed companies meet DFM reporting deadline. And Eurozone approves Portugal's bailout and shifts Greece strategy. Let's look at the equity markets first. Both UAE bourses ended the trading day with a plus, the largest in almost a week after the Dubai government rescued Islamic-led Dubai Bank. The DFM General Index gained 1% to close the day at 1,578 points. Arab Tech Holding was one of the best performers with a plus of 3.8%, followed by the Dubai Financial Market, which rallied 3.3%. Logistics company Aramex gained 2.2%, while Dia Development rose 0.7% and Drake & Skull International was up 1%, as was Union Properties. And Emaar Properties, which held a 30% stake in Dubai Bank, climbed 1.9%. 133 million shares were traded, valued at 137 million dirhams. And over in the capital, the ADX General Index was up 0.4% to reach 2,650 points. Best performing sector was the real estate sector, with Alder Properties gaining 1.4% and Sur Real Estate rising 1.5%. The banking sector was also strong. Abu Dhabi Commercial Bank rose 0.4%, National Bank of Abu Dhabi climbed 0.9%, while National Bank of Fujairah rallied 10%. One of the largest losers was energy company Taka, which fell 3.7%. 52 million shares were traded, valued at 73 million dirhams. And let's now look at the GCC equity markets. The country's main benchmarks ended mixed today. European finance ministers in Brussels for the first time raised the idea of talks with bondholders over extending Greece's debt repayment schedule, saying that last year's €110 billion rescue for the country has failed to restore its financial health. A large restructuring of Greek debt, however, remains taboo. To talk about this issue further, we are now joined by Tim Fox, Head of Research and Chief Economist at Emirates NBD. Welcome, Tim. So, what do you expect will happen now? Do you think Greece could face a restructuring of its debt, and what would that mean for bond investors?
Well, I think increasingly the options are running out for Greece in terms of what might lie ahead. Populations increasingly are becoming more restive in terms of the richer countries in the Eurozone opposing measures to provide further bailouts for the Greece economy. And I think at the end of the day, a formal restructuring would seem to be the most likely outcome. That will probably entail some cost to bond investors as well, as the country cannot rely on external funding coming from other national states and other national members of the Eurozone.
Let's look at the UAE. Its economy grew 1.4% last year, according to media reports this week citing figures from the National Bureau of Statistics. How much of this growth relies on the surge in oil prices, do you think?
Well, certainly oil played a significant part in the growth in the UAE economy last year. The average oil price in 2010 was just over $80 per barrel, as opposed to just over $60 in 2009. And it looks likely that this year, certainly that will be even greater. So the oil component will be larger again. But that was not the only story as far as this GDP and growth report is concerned. The non-oil economy also grew considerably. And in fact, as a proportion of the economy as a whole, the non-oil economy grew to around 69%, up from 66% in 2009. So the non-oil sector is becoming more important for the UAE, and the UAE is not wholly and only reliant on oil as a driver for economic growth.
Thank you very much, Tim. And now to our top stories. UAE telecom operator Etisalat plans to spend between 2 and 3 billion dirhams annually on infrastructure over the next 5 years, including the rollout of a fourth-generation mobile network. According to press reports, the firm's acting CEO, Nasser bin Aboud, said the operator's 4G mobile network will be launched very soon, starting with the main cities in the Emirate. He added that Etisalat will also invest in its data cabling and IT system, and that the company will not need to look at funding options, as it has sufficient reserves for its expansion. Etisalat is also looking to sign an infrastructure sharing agreement with rival Du by the end of this year. In terms of royalties to the government, of which the company pays 50%, Ubud said the issue has been under discussion for some time and that it is being looked at by the government and stakeholders. The DFM announced that all 44 UAE-listed companies on its bourse disclosed their quarterly results for the first quarter and therefore met the 45-day deadline. However, the Dubai Exchange suspended trading of 8 foreign companies that didn't issue their financial statements within the time given. Meanwhile, analysts and investors welcomed the move to allow companies to cross-trade on the Dubai financial market and Egypt's benchmark index, as it will help boost liquidity. Volumes will increase even further should the MCI upgrade the UAE to emerging market status, a step highly anticipated by the exchange operators. The upgrade would put the UAE stock market on the radar of an estimated $5 to $6 trillion in assets under management by institutions that track MCI emerging market indices. And in our fast financial news, Dubai-based facilities management company Emcor Facility Services is on track to achieve a project backlog worth 1 billion dirhams in the second quarter of this year, according to a company statement. The firm, a former subsidiary of Drake & Skull International, is looking to cross the $5 billion mark by 2015. Emcor is also looking at going public to raise further capital in order to continue growing. The Department of Economic Development and Emirates Post have signed an agreement for the payment of new, renewed and amended trade license fees. According to officials, the agreement will facilitate faster and easier payments and enhance procedures for trade license fees. And after the break, we'll run you through what's making the headlines in international business today.